Hey guys, welcome back. I'm really excited because I've got Jordan Moorhead with me. He is actually out of Austin, Texas. But what I think you guys are really going to appreciate about Jordan is his diversification in real estate investing, but also the ability for him to invest outside of his own backyard. And Jordan's a great guy. I know him through a mutual friend, Ron Orr. Shout out to you, brother. And so I appreciate the introduction. And Jordan's just been crushing it, man. So Jordan, I wanted to get you on here and let's spread some of this brain knowledge and wealth that you have with everybody. Thanks for doing this with me.
Oh, thank you so much for having me on.
So you're in Austin, all right?
Hmm.
Keeping it weird, right? And
Yeah, Brian.
very cool city. And you've been investing in real estate since 2016. So definitely not a newbie. You also have a podcast around real estate investing. But let's run through the different types of real estate investments that you have experience in. You mind if I read them off real quick?
Yeah, absolutely. Go ahead.
All right. So I've got house hacking, I've got Airbnbs, I've got live in flips, mobile home parks,
Mhm.
small multifamily, and a brokerage business that focuses on retail single family brokerage. And so you're really well diversified, but all into real estate, just different angles. So you've got kind of your, as my buddy Chris Rude would call it, your fast, medium, and slow money going. You've got your,
Yeah, there you go.
your brokering income. You've got your, that's the short term, that's the money that comes in from every transaction. And then you've got all these buy and holds, and which are going to be your long term. And then that middle term is that live in hack or that
Hmm.
live in flip. So tell me a little bit about what is your focus? Why are you doing what you're doing right now? Because obviously this is spread out across a lot of things. I can't do that many types of real estate. I'm not that
Sure.
not that coordinated.
Yeah, and I think a lot of those have happened at different points in time too. So for me, house hacking got started, and there was no reason to not to continue to do it as I was building up my portfolio and growing my business. Uh, the brokerage business is my main business still, but I'm heavily focused on buying mobile home parks at this point in time. And if there's an opportunity to buy more single family that makes sense, we would do it. We just we had a really nice window there for a few years where everything seemed to make sense that we were buying, and it's gotten more difficult, and our focus isn't there. So we haven't bought any single family in a few years.
Got it. So it's kind of more timing related. The house hacking made sense. Then
Hmm.
you started doing the buy and hold. Now
Hmm.
you own some mobile home parks and you're buying more. And then tell me about this live in flip. Still the same concept as the house hacking. Basically, you just, instead of having people rent from you, you'd also just basically move in, turn around, and sell it after it's rehabbed.
Yeah, so we did that. Not actually planning it to sell it as quickly as we did. We were going to do the 2 year where you don't pay taxes on it. So do you live in it 2 out of 5 years, you can exclude up to 250 as a single person or 500 as a married couple. And we lived in it for a year. We just really didn't like the area, so we sold it. We made a little bit of money and moved on into a house that we're in now. That we will do the same on, but we don't have a specific timetable as far as when we want to sell it. So we
Got
like
it.
to buy things that are not so great of a shape, fix them up and make them better, and either hold on to them or sell them.
So even on the residential side, in your personal residence, you just want to buy it right. It's basically what you're
Yeah.
saying is you're buying the house that you're moving into right,
Hmm.
and if you flip it within the next year or two or more, you're gonna make money on it. Is what I
Yeah.
hear. Yeah, actually, I've done the same thing. I bought. I did that quite a few times actually. We would buy a house because I was flipping houses from 2008 to 2013, and so being in the business, it's like
Yeah.
I've got no place to be, no kids at the time. So you just, buy a house, move in, rehab it with the rest of the houses that you're rehabbing. And
Hmm.
then once you're done living in it, you just sell it, make a profit, move on to the next one that you like. I did that probably 6 times, in a
Nice.
few years. It was pretty intense. And then we finally said, forget all this. Let's build something and let's stick around for a little while. Um,
But you did it there too. So you added value. You found a piece of land. There's no improvements whatsoever, and then you added value by building a property. When you go to sell that, I guarantee you'll make a lot of money on it.
we will. at the peak, we tripled the value.
Yeah.
Yes. So, and that's based on our cost. So we,
Mhm.
and I agree. We bought the land right. We built the home right. And so we've got a
Mhm.
ton of equity in that too. And it was really because we just couldn't find a house that we wanted to live in for a while that made any financial sense at the time because it was just the market was so crazy. So definitely have some experience doing that, just like you. I like that model. And for people who don't have to stay in a place for a really long time, they're not tied down anywhere. It makes a lot of sense. You mentioned a 2-year window. Can you just explain what that is to the listeners? Those, because we got a lot of commercial real estate investors and entrepreneurs here. There's
Mhm.
a lot of people who probably don't know about that tax hack.
Yeah, there's so many hacks with the residential real estate space, and one of them is that the two if you live in a property 2 out of 5 years. So if you lived in it for 2 years, moved out for 2 years, and then sold it, you would have lived there 2 out of 5 years. If you live in it 2 out of 5 years, you can exclude up to 250,000 from taxes. If you're a single person, if you're a married couple, you can exclude up to 500,000 from being taxed. So most people, I would say, that sell their home probably don't pay any tax on that gain. They probably make
Yes.
50 grand, 100 grand, something like that. But you can make significant amount of money. And in Austin, there's neighborhoods where houses were 200,000 to 300,000 20 years ago, and now they're selling for 2-3 million. People are doing a very interesting strategy. I thought this was super cool. So they're living in it for, let's call it 20 years, 10 years. Then they're moving out, renting it for a year. So they still get the 2 out of 5 exclusion. But since they've moved out and rented it, they're excluding that 500,000 from tax, and they're 1031ing the rest and doing investment property. It's just a 1031
get
intermediary told us about that.
Wow. So you're actually getting the benefit. So let me recap this. So I got this.
Mm-hmm.
You buy a home relatively cheap. You live in it for a long period of time. Okay. If your equity exceeds what the IRS will allow you to not pay taxes on when you sell, you basically move out for a year, you rent it so it becomes an investment property, and then you're able to do a 1031 exchange with all that extra equity that you were going to pay taxes on into the next deal. So you
Yeah,
actually don't pay taxes on that massive gain that you accumulated.
I thought that was really smart.
That's really smart.
Yeah.
That's
Uh,
really
uh,
smart because that's actually an issue that I've not heard of that. That's an issue that we're going to have. We're going to exceed well over $500,000 in gains on our
mhm.
house that we built, 4 years ago. And I'm like, okay, well, that's kind of got me sticking around a little bit longer if I'm going to have to pay taxes on all this. But, that's actually a great point. I'm going to use that strategy.
There you
So
go.
that's
Buy a
great.
park with the 1031.
Jordan's already hitting us with the hacks. Love it. Exactly. Yeah, roll that into a park, roll it into whatever else. But the key is you're sticking it to the IRS and being able to move on and take that cash and roll it. So I like that. All right. So another interesting fact about what you're doing is you built a portfolio of like 34 single family homes in Kentucky,
Mhm.
and you're in Austin, Texas. Now, just so everybody understands, I mean, buying commercial property, buying, a mobile home park or a larger apartment building or, something that's larger out of state is pretty common because you can afford an on-site manager, right? And it kind of runs itself, and it's it's pretty easy to manage out of state when you get into larger properties. The challenge that I see though is on single family or even small multifamily when you've got, that many single units on scattered sites out of state. Management just seems like it would be brutal. Can you talk about that a little bit? Maybe how you're structured from a management standpoint there?
Yeah. It does help that we have as many as we do. So we had more than that. We've sold a few. We actually sold a few and bought the 2 parks we have with some of that equity. It helps that we have as many as we do because, for one, the manager cares about us because we're a big client. They're always involved in what's going on at the property. But I have a business partner that lives locally, so he's kind of the boots on the ground. He's keeping track of what's going on with the manager. The manager's keeping track of the properties. It as far as they're not so spread out. So again, the scale helps, but they're all within about a mile or two of each other.
Okay, that's really close.
Yeah. So we
That's
really
really
bought all
close.
in one little pocket. We didn't buy all over the city.
You can walk to the units. It's like one big multifamily property.
Yeah.
If you really wanted
Yeah.
to in a mile. Yeah.
But again, it
Okay.
does have the drawbacks of single family still.
Sure.
Even with them all, we've overcome a lot of the drawbacks by having as many as we do because we have a little bit of scale. If we have one vacancy, it's 1 out of 34 versus 1 out of 1.
Yeah.
And having them all in the same area helps a lot. But we still do run into all the same problems with single family, and we can get killed on cash flow because we've got a couple AC units go out and your cash flow for the whole deal is gone, because they just
That's
don't cash flow
wait,
that well.
hold on. So two things. Remember what you just said because I want to go back to that. All right.
Sure.
I don't want to get too far ahead because I think you've got some really good nuggets here that the listeners can pick up on. Your strategy for buying single family homes out of state is number one, have a partner on the ground, right?
Mm-hmm.
So he's familiar with the CapEx, all the work that needs to be done. He can go check on things, whatever. Secondly, you have a property management company managing them. Third, you have all of the units within close proximity of each other. So you've got economies of scale within, a close area of the others. So you're able to have your management company run around and take care of those pretty efficiently. And I think that's a winning system. Partner on the ground, third party management company, and having all the units at scale within a
Mm-hmm.
very close proximity. That's
And they
cool.
were all burrs too, so we did pretty comprehensive rehabs on most of these properties, and we did stuff like replace the pipe the piping, replace the electrical when needed. So we did a lot of work on plumbing. We did a lot of work on electrical. If we needed, we did roofs, windows. Pretty extensive rehabs on these properties. So that helps with the capex being lower too. Not that we don't run into it, but it's better than it would be.
So that's the secret system for managing single family homes out of state, basically. I
Mm-hmm.
like it. So you started to say something else, and I want to touch on this because I appreciate when people are not fanboys about what they're doing, but they're honest and transparent about the good and the bad, right? And you just said something that stood out. You said if you have a couple ACs go out, you wipe out your cash flow on those. And that's something that a lot of people, when they're looking at single family homes and small multifamily like duplexes and fourplexes, they just don't realize the CapEx can completely wipe out returns for a long time. And so you've got the scale, so you've got a lot of cash flow. So that probably helps, from the standpoint of being able to float some of that
Mm-hmm.
as a whole. But can you maybe talk about what does cash flow actually look like on a single family unit, net, and what does that look like when you do have, major roof issues, AC goes out, something major happens?
Yeah, so being completely honest, they don't cash flow very well at all, even with that many of them, even at the prices we bought them at. So we bought them, I would say, on average in the $90,000 home range. So we have 34 of those. They're probably all worth about 150 to 160 now.
Yep.
And the rents have gone up pretty considerably, actually. So they've gone up from, I would say we were in the 800 to 1,000 range when we bought them and initially rented them. Now we're anywhere in the 11 to 1,400 range. So rents have gone up a fair amount, but they still don't cash flow very well. We don't have to put any money into them, and we could take some money out, and we use the money from that business to fund some of our mobile home park expenses. Sorry, as far as like the infrastructure to acquire mobile home parks. So we have
Sure.
mailers going out. We have a cold caller. We're buying services to help find mobile home parks, and that's paying for all of that. And we're fairly conservative with how we pull money out, but we still don't cash flow that well. They've built an amazing amount of equity, though.
Yeah. Sounds like you're going to make a lot of money on that in the big picture. And that's really what that is. That's a wealth creation strategy. but it's not a cash flow strategy
No,
that anybody's going to be living on, at least too lavishly. So I think
no.
that's a really good point, because there's a lot of new real estate investors who go, I'm going to get into single family home investing. I'm going to start buying homes. I'm going to house hack, and I'm just going to build up this cash flow, and I'm going to be able to, live off my rental income on single families or duplexes. And you're saying it with 34 units, uh, cash flow is not too sexy. It's actually more of a equity growth strategy.
I think we would have to pay them off or get the LTV very low to have it at any sort of point where we would be living off the cash flow from them.
Yeah.
Because they're not cash flow properties. They're single family homes. They were never made for cash flow. They're never bought on cash flow. You're just trying to fit a square peg into a round hole with
That's a
that, really.
really good way to put it. And you also said something too that stood out, is you bought them right.
Mm-hmm.
If you're going to buy single family homes, buying them to where they squeak out $100 or $200 a month in positive cash flow at market value is a sure way to fail in real estate. I mean, it's just, you're going to get hurt. And so
Yeah,
the strategy is make sure that you're buying them with equity so that you make money on the purchase. It'll cash flow that much better. And ultimately the play is pay them down and then sell them, right? Or use
yeah.
them as, a tool to pull credit off of or something like that. So that's good. What's kind of your biggest headache in that business?
To be honest, that's a very hands-off business for me because none of them are here. I know my business partner deals with a lot more at the headache because
Yeah.
he's local, but
Note to self, don't be the on the ground partner.
it's not that bad, really. I mean, the biggest headache is we just not, we have this amazing amount of equity in these properties, but you can't eat equity.
Yeah.
So that's the headache is that,
So
you
you
bought
end
all
up
these
having to sell
properties.
or
We're going to need to sell them. That's the reality. We're going to need to sell them and 1031 into something that makes more cash flow.
could you also pull just a credit line, do a line of credit across all of them? Because it's the same ownership group, right?
Mhm.
So if it's the
Yep.
same ownership group, you could just do a pooled credit line, cross collateralized across all of the homes and kind of draw down on that. Although that'd be pretty ugly from a, you know, payoff standpoint. If you decide to sell a few of them, I'm sure they could structure it for you, but might
Mhm.
be a way to be able to draw on that equity a little bit for short term.
Yeah, we'll certainly look into that. So the way we bought them, a lot of them are financed in the same loans. So we kind of have tranches of these houses in different loans.
Okay.
So sometimes it may make sense. We'll probably keep some of them because we got some of them for great deals and they do cash flow pretty well.
Yeah.
But some of the others aren't so good. We'll probably just pare down the portfolio and keep the good ones and take the equity from the not so good ones and repurpose that.
Yeah, and I think what you're also kind of showing the listeners is that you can have different types of real estate investments that feed the others, right? So you bought all these single families, they produce income. Okay, maybe not a lot, but they produce income. And you said that you guys are distributing some of that cash flow, taking that cash flow, reinvesting it into marketing and tools to go out and
Mhm.
buy commercial real estate, mobile home parks or whatever else for longer term buy and hold on those as well. So you're kind of taking the cash flow from one, using it to grow your portfolio into different property type that's going to really create a ton of cash flow and a lot of wealth there too. What's your thoughts on residential versus commercial? Because you're dabbling in both, right? I mean, you're playing with single family, like you said, really not built for investment purposes, but you can make money doing it. And then you've got mobile home parks or other commercial property that's valued based on the cash flow. Kind of give me your thoughts on the two different.
I don't think one is better than, well, sorry, one, depending on what your purpose is, one is better than the other, but I don't think one is right or one is wrong. Commercial real estate, you're buying it based on the amount of money it makes. And that makes more sense from a business perspective, especially when you're looking for cash flow. Um, Residential real estate, it's easy to build a lot of equity, in my opinion. And with these properties, again, we built a ton of equity and it wasn't that challenging because these were all in areas we knew well. So I'm from Louisville, Kentucky. My business
Okay.
partner lives there. We knew the areas. I didn't hang out there as a kid. It wasn't necessarily the area I grew up, but I understood it well enough. We understood the areas, we understood the clientele. Everybody knows what a house is, type deal.
Yeah.
It's easy to get started. And
So make sure that you know the neighborhood that you're buying in. That's another tip.
yeah, yeah, and it really, I think that both have a place. I don't necessarily think that you can't do one or the other. I know a lot of commercial investors that still own a fair amount of single family, or use, you referenced this earlier. They use single family to help build equity, and then they repurpose it into commercial real estate.
Yeah.
So there's not a wrong way to do it.
I think that's a great strategy. Buying a bunch of single family homes, build up your equity, use that equity, then go buy commercial real estate or do other strategies. There's a lot of people who flip homes for the same reason, or they
Yep.
wholesale because they're basically creating chunks of cash to then take that, roll it into commercial real estate or buy and hold real estate in general. And they use the upside that they make on all those wholesales and flips, and they put that into long-term buy and hold properties. So you
Yeah,
can kind of
or
mix
invest
and match.
passively. I think that gets, you don't have to go do it yourself. You could go invest in your mobile home park fund, so you could be creating equity over here with the residential space, and taking that equity, investing it passively into commercial real estate. 10 years later, you're going to be pretty happy.
Jordan, that's a really good point. And I've told several people that. I have a good friend of mine who makes an insane amount of money wholesaling. Okay.
Mhm.
An insane amount of money wholesaling. And he's like, yeah, I think I'm going to start investing in apartments. And I'm like, cool. What's your game plan? He goes, well, I'm just going to study up. I'm going to start looking for deals. I'm going to start marketing for apartment buildings. I'm like, okay, so you're going to slow down or get distracted from making 7 figures a year
Mhm.
wholesaling with 0 employees. I mean, the dude just crushes it. And you're going to go buy apartment buildings? He's like, yeah, I want passive income. I want to grow wealth, blah, 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 all the same thing everybody says, right? I'm
Mhm.
like, no, dude, you don't understand. That's another business. Like, that's a
Yeah.
totally separate business. You need to figure out how you can stay focused on what's paying you this crazy amount of money and you still have free time in your life, and go partner with somebody, go invest in somebody's fund, syndication, whatever. Partner with an active operator that does it day in and day out so that you can continue to do what makes you all the money. That's where you store the money and let
Mhm.
somebody else generate that passive income for you, because then it's truly passive. But if you're going to go out and start buying this stuff yourself and operating it, it's no longer passive. It's a separate business, and one of the two is going to lose. And
Oh
so
yeah.
I think that's a great point. Make the money where you can make it and then deploy it with people who are really good in other asset classes. Yeah,
Yeah. Yeah.
that's good. I guess you've been in this business for 8 years, right? 2016, something like
Mhm.
that.
I've been investing since 2016. I got a real estate agent's license in 2017.
And that's your flip, right? I mean, that's your chunks of cash. You run a business, which is your real estate business, where you actually help clients buy, like house hack, right? I mean, is that kind of the typical client that you're working with? I refresh my memory on who your client is on the real estate agent side.
Yeah, absolutely. So I have a team of realtors that work with me here, and our primary client on the buy side is a house hacker or a newer investor, and we work with a lot of first-time home buyers in there too, just because of that
Sure.
archetype right there. On the listing side, that's most of what I do anymore. It's almost all flippers. So I don't flip
Interesting.
myself, but I help quite a few flippers list and sell properties here in Austin.
Well, I will tell you that that is a very good strategy, because I had a brokerage in Minnesota in 2008. Okay, 2007, 2008. Think about the timing there,
Yeah.
right? I was not buying myself, but I was helping a lot of people buy, and then I would help them sell. So I'm
Mm.
making money on the front end and the back end, right? But I'm not taking the downside risk that those guys were taking. And I wasn't telling them to buy bad deals. I mean, I was giving them the best advice that I possibly could. They were buying good deals, but they were taking the risk, and I was making money on the front end and the back end without that risk. And that's a
Mhm.
really good place to be when the market is doing this.
Yeah.
For those who are watching, who aren't watching, I'm giving a straight up. Like when the market is crazy hot, you're taking risks at buying and holding things that you intend to sell to make a spread. Especially if you're doing it in volume and your spread is pretty lean, you're better off being the agent, helping them on the buy and sell side, making your money without the risk. So it's a very good position to be in, because when the market stops, music stops on you, you've got listing contracts. You don't have, a bunch of inventory you got to move. So that's a good place to be, Jordan. What's your biggest challenge in that business, would you say?
So biggest challenge, the Austin market has had a rough couple of years, but the biggest challenge that I'm having right now, getting listings sold is challenging, but we're still moving stuff. Really, the biggest challenge is finding motivated real estate agents that want to join our team that also understand investing. So I'm pretty picky. I only want to work with people who understand investing and that are investors themselves, because we work with so many newer investors and so many house hackers. And finding that unicorn, the person that understands investing, it's a hard worker, it's going to get out there and do the work, is challenging right now. And it's odd because you'd think nobody's selling any houses. They've got to want to work hard right now, but it's not the case.
Yeah, that is interesting. And what you're saying too is your focus is on the listings and recruiting, right? So,
Yep.
you're sourcing the sellers, but your sellers are doing multiple deals. There's a lesson in that. If you're going to do transactions, be positioned to do multiple transactions with the same client, ongoing business, versus doing one-off retail sales where you get a listing, you put it on the market, you sell it, and then you got to go find another client. Here, you've got the same clients providing the inventory, essentially. They're providing the inventory to you, essentially, and you're able to just keep selling that for them. So it's ongoing business. Plus, when retail buyers aren't necessarily active, there's still investors out there doing stuff. So
Oh yeah.
is Austin, let's talk a little bit about Austin, because that's kind of like a little bubble, right? It's a very unique market. Most investors around the country hear about it. Can you kind of give us some of the dynamics of Austin that maybe are unique to that market versus like Kentucky, where you're investing in?
Sure. Absolutely. So Austin was a rocket ship of appreciation for really the decade from 2022 prior. It was 10% plus a year. 2020 and 2021 and 2022, early 2022, we were multi-double digit appreciation a lot of years. And you were getting 10, 15, 20, 25% appreciation a year. People were buying stuff to flip. And while they were holding on to it, doing the work, it appreciated 5% on top of the value they added. So it was just such a crazy market. They thought they were investing and they were speculating. They'd buy a house, say, I'll hold on to it for a few years until it gets up to this value, and then I'll sell it. And that worked for a lot of people. That's not the type of investing that I understand.
Yes.
And I kind of felt like an idiot at some point in time. I said, I'm missing out here. People are doing this investing where they're buying a single family home that doesn't cash flow, but they're selling it for 100 grand more next year. That stopped when interest rates started to go up in May of 2022. And it stopped.
Remember when I said when the music stops? Yes, keep going. But yeah, it
stopped
happens
in a big way. Everybody thought interest rates weren't going to, and you know this in the commercial space, nobody thought interest rates were going to go up as fast or as high as they did. It was impossible to see. In retrospect, they were as low as they could have possibly gone. The fact that we didn't expect them to go up is kind of naive and absurd too. But
very.
So interest rates went up from around 3% for a residential mortgage to 8% in October of 2023. Austin's home values in about the same time went down about 25%. So May 2022 to now, you're down 20-25%. And you're still up, like based on the last couple of years. So we're
One
down
or
to
2
like,
years worth of gains lost.
yeah, it's very neighborhood specific, but we're down
Mhm.
to late 2020, early 2021 prices in most places. So if you owned a home before that, you're still in the green.
Yeah,
If you bought a home after that, you probably don't want to sell that home for a year or two, at
yeah.
least.
What you talked about something that I want to point out. You said at certain points you felt like you were an idiot because you were missing out on what these investors were doing, which
Mm-hmm.
was speculating. There's a big
Speculate.
difference between investing and speculating. All right. I've had that feeling in the past too, where I'm like, man, I should just do this strategy that everybody else is doing. But I remember 2008 very, very well. And that was exactly what it was. There was no cash flow focus, it was all on gains. And
Mm-hmm.
when the music stops, like you said it did, you can get very, very hurt with that strategy. Can you maybe talk about kind of what you were seeing happening and kind of how that affected some of the investors who were doing that strategy?
Yeah. So, a lot of people were flipping, a lot of people were buying homes and just holding on to them for a year or two and watching them appreciate. Because and again, if you looked back over the past decade, you could reliably predict at least 10% appreciation a year. I would say on average, it was 10% a year. So if you bought $500,000 house, let's say your sales cost on a $500,000 house would be about 30 to 40 grand. Even if you just held it for a year, you were going to be in the green if you sold it. So you said, hey, it's appreciating more than that these last couple of years. So I'm going to hold it for 2 years and I might make 50 grand just for holding onto a house. And maybe you lost $200 to $300 a month renting it. You said, I'm only going to lose 8 grand in 2 years. I can do that to make 50. Uh, but again, like you mentioned, it wasn't investing. And we haven't seen so many people get burned badly yet, but we have seen quite. I work with a lot of flippers. I get a lot of the leads that they're not able to close. I have seen quite a few people who bought at the peak and now need to sell their homes and move to other places and can't because they don't have
Yeah.
any equity. As far as the investors, we had a weird time where everybody that was doing a long-term rental that now couldn't sell their home moved to a short-term rental or a medium-term rental and really flooded the market with those too. So our available supply of short and medium-term rentals went through the roof, which conversely dropped the rates of those properties considerably. And that hurt people like me that were doing medium-term rentals, short-term rentals.
So with the short-term rentals, that's something that I haven't heard a lot of people talking about lately, but for a while there everybody was complaining because they bought these homes with the expectation that they were going to be able to rent them at a significantly higher rate on short term, and then either there were government regulations in the area that were stopping them from being able to do it, or the market got flooded and rates came down and they had a lot of vacancy and they weren't able to get the revenue that they expected. Did you see a lot of that in Austin?
Not as much in Austin. There's quite a few short-term rentals that people did. You can see them selling them because they're not doing as well as they thought. These really unique properties with cowboy pools or interesting pools put in them. I was looking at properties with pools yesterday, and I would say more than half of them aren't a real pool. It's some extra pool somebody put in for a short-term rental to make extra money because it's hot here in Texas about half the year, and having a pool is a big plus. So they are trying to sell them, and I would imagine in a lot of cases they're probably selling them at a loss for what they bought them at and the amount of money they put in. Um, it's just, it's an interesting space where to do it well, you need to be so unique and you need to run them so well and you need to have such a nice product that a lot of people for so long got away with just a mediocre product and a mediocre
Yes.
location, and they were making killing money. But I have so many friends now with short-term rentals that are just kind of begging for somebody to come buy them.
What's
whether
the
it's in Austin or down on the coast or Smoky Mountains.
what is the strategy for that then? I mean, if you're gonna do it right, what's the strategy? Like how should you buy them price wise, all of that to not be in that position like some of the people you're talking about?
I'm trying to think of a nice way to say it. I don't think it's a good strategy. I don't think it's a sustainable strategy. I think there's only so much demand for a short-term rental, and it has to make a lot of sense for somebody to book it rather than just go to a hotel. The
Yeah.
ones that I see that work really well are really unique luxury properties in really good areas. And they're bigger than you could get a hotel room or two. So it sleeps 6, 7, 8 people, maybe
Yeah.
10 people, 15 people. Those are still working really well for people. It's the big properties that are really unique that you would take a group of people to.
Yeah. Yeah, that makes
That's the
sense
reason.
because you would have to do it you'd have to do like an event at a hotel or a family, family event, we'll call it, at a hotel. And that's not quite as fun as having a mansion to have, you know, 8 bedrooms and being able to have kind of functions. I've been to some masterminds like that where everybody stays there, which is a great way to do it. And
Yeah.
that makes sense. It's a little bit more unique, and there's a reason why people would want that versus just a cheap single family home, that's stocked up with things in the fridge. You can just go to a hotel and it's nicer.
Yeah, and that's kind of where medium term rental fits in too, but there is a little bit of a supply issue with that. I would say right now, so you really have to be careful in what you're buying. If that's your only strategy, I think it's it's got to be the right property in the right area because there is a lot of demand. People that need it for a month or two.
Interesting. Tell us a little bit about the medium rental. How's that different from short term and long term? I mean, obviously it's for shorter than long term and longer than short term, but what's kind of the difference in strategy on something like that? Because that's not something that I'm familiar with.
Yeah, it's cool because it's not short term rentals that have to be really unique, awesome properties in such a great area. It can be just a nice property in a good area that's furnished well, and it's something that somebody might need to traveling for work. We're lucky here in Austin. We get a lot of people coming and going for medium amounts of time, whether it be 30 to 60 days, or they're dislocated. Their house got flooded, they're remodeling their home, or they sold their home and are moving somewhere else and need a place for a month in between. We get a lot of that. Would say our medium term tenants are about 50-50 from Austin or from out of town coming here to work.
Interesting. So a lot of them are local.
Yeah,
Like
they're
you said, I guess
dislocated for
because
some
they're
reason or
remodeling
another.
their home or they're in between homes because they're selling theirs, buying another one, whatever, and they need to fill a gap.
Yeah.
Basically. So we rented a condo in Utah for a month, and that was kind
Yeah.
of our way of just escaping, the heat of South Florida for a month. And I think this coming summer we're going to do 2 months. Now, that's probably not considered short-term rental, right? Although I think they do short-term rental in that unit. I'm probably more of that medium-term client, right? I mean, for a
Yeah.
month or two at a time. Okay.
We love
So
doing that too. We've done that overseas. We did that in Nice, France for a month. I mean, like, there's a
Nice is
lot of people
beautiful.
that travel that way too. We like to go spend time somewhere if we're going to go.
Yeah, if you're gonna and along those lines, I mean, we worked, it wasn't like I just did nothing. Of course, we spent more time exploring and hiking and doing, I broke my foot, so the hiking was a little bit limited on that trip. But in general, we're able to spend, time exploring and enjoying it. But we also worked. It was like it wasn't really a vacation. We were just living somewhere else for a month. And so that okay, so medium term, I understand that then. It's not your short-term vacation person for the weekend or the week. It's they need it for extended period of time for one reason or another, and they need something probably bigger than a hotel room
Mhm.
because they've got
Yeah,
a
because they're
family,
going to
they've got
work.
dogs, whatever. Okay. Got it. So, Jordan, give us some wisdom here. All right. You got somebody who's getting into the real estate game. They don't know what direction to go. they're saying, you know what, should I buy houses? Should I get into this mobile home park thing? Should I buy, commercial property? Like, what should I get into the brokerage business? What the heck should I do? How would you tell someone who wants to be in real estate badly, but just doesn't know what direction to go? What would they do? What should they do to get started?
I think almost anybody and everybody should get into house hacking in some form or fashion, and especially if you're new. And it doesn't have to be a duplex. It doesn't have to be a single family. It could be a single family property with an ADU that you could rent out on Airbnb. Um, it depends how much money you have, but for 95% of the people, that's going to be the easiest, cheapest, and lowest risk way to get involved, in my opinion.
That's a good point. Okay, so house hack, maybe even do an ADU, which is explain what an ADU is for those who don't know.
Yeah, it's like a garage apartment, so it's a 1 or 2 bedroom unit, typically on the same property, probably pretty close to your main unit. Maybe it's a mother-in-law suite, that type of deal. And you just rent that out to somebody else. I would say the only reasons not to house hack are you have so much money that you don't care. You've got the money to lose. You've got money to take bigger risks right off the bat. If you make, like you mentioned, your friend that makes 7 figures a year, he probably doesn't need to house hack. And house hacking can be a great way to get acquainted with real estate investing with very low risk. But for him, he could just go buy a rental property or give the money to somebody else as a passive investment and get started that way. So I
That's
think you
awesome.
really have to evaluate what's your highest and best use of time. When I got started, I had $6,000. I didn't have a lot of options.
Yeah. Slightly limited there. Yeah.
Yeah.
But you did
And I
it.
didn't know how to raise private money or, so
Yeah.
all I could do was get an FHA loan.
Yeah. Hey guys, if you're looking to invest in mobile home parks and you want to be the active operator out there buying deals, get with me over at getrealcashflow.com and I'll show you how to do it. I'm helping a bunch of other investors go out and buy parks, buying their first parks, I should say, and being able to go out and scale their portfolio into that commercial side of real estate, not just the single family. So getrealcashflow.com. So that's a really good point there, Jordan. Get in where you fit in, right? I mean, like if you're if you got $6,000, you're probably just house hacking, right? To get started.
Yeah.
If you've got millions, you might just be a limited partner passively investing in different funds or limited partnerships or syndications because you can, right? So that's a good point. Is there okay, I got you. Any final feedback for the listeners, advice that you would give investors based on your 6 years, or sorry, 8 years and sizable portfolio growth that you'd be like, hey, if you're going to be doing this, this is the one big learn that I've had?
Yeah. And I was told this from the beginning. Most of the lessons I've learned have been explained to me, and then I've had to learn them again through real life experience. So I would have gone bigger faster. So I just started investing in mobile home parks about a year ago today. Well, about a year ago, I started investing in mobile home parks. I started learning about mobile home parks in a real way in 2019. And, I knew that was a good strategy. I knew it would pay off, whether it be that multifamily, whatever it was. I knew about these more scalable strategies way before I got into them. So I would go bigger faster.
That's
Yeah,
great advice. I tell people that all the time. Go as big as you
exactly.
comfortably can. Like, go as big as you comfortably can, because the faster you go bigger, the bigger you get, right?
Mhm.
That's really good. That's really good.
I think it's just easy to get comfortable with smaller deals. Or obviously, buying a single family home as a rental, it doesn't take a lot of gumption to get that done because it's something everybody knows and understands. It is a big deal. Buying your first rental is awesome. You're in a
Yes.
class that most people aren't ever going to be in if you own more than one property. But I think once you get comfortable, in my opinion, once you get comfortable with buying real estate It goes like you said, as big as you comfortably can. And I did that for a few years, probably 2 years when I first got started. And then I got comfortable and stopped pushing the envelope.
Yeah. Well, and if you think about it, there's a little bit of a misconception because people think that by going small, they're playing it safer. But it's actually not true, because if you look at a single family home investment, there is a single tenant in that home. And when that tenant decides to move out, you go from 100% to 0% occupancy overnight. But if you buy a large property with a 100 tenants in it, you have a 1% decrease in occupancy when one tenant moves out. So you don't feel it, right? So the question is, which one is safer? Well, it's the larger diversified tenant base than the single tenant. But based on the dollar amount, people feel very comfortable with the single family and the larger assets, which, honestly are more complicated. They're more complex. It's a different valuation process and all of that. But they feel more comfortable with the single family home because that's what they know. And it's smaller dollars than the bigger multi-tenant type buildings. So I think safer is actually larger in many cases.
And I would say, even for an additional reason, I've been thinking about this a lot recently, because I would not say I'm an expert at underwriting by any means, but you also have this backup underwriter is the lender. When you're buying a multifamily property or commercial property, the lender is making sure the property is going to do the job. With single family, there's nobody watching your back there. They just care if you're going to qualify.
Yes. Yeah, they're really qualifying you personally and whether you can float it if you have to. Where on the commercial side, they're looking at it as a business and making sure that the business supports the debt, and they're kind of checking all the boxes right behind you. Now, doesn't mean lenders are always that great at it either, or they don't understand some of the risks involved, because a lot of times lenders will lend on a lot of different property types, so they don't know the nuances. But there's a lot of truth in that. You do have someone looking over your shoulders, checking your numbers, asking tough questions, making sure hopefully that you're ordering some of the third-party reports, although a lot of the lenders don't even understand some of the third-party reports. But, they at least know to get a survey, a boundary survey, and they at least know to make sure that you get an appraisal or whatever. So they do, in many ways, kind of act as a backstop to help protect you against risk. I agree with you on that, Jordan, for sure.
Yeah. So the residential lender doesn't do any of that at all.
Nothing. It's comps, right? They just make sure that you're not overpaying for it and that you can float it with your W-2'd income. Okay, so super good advice, Jordan. Love what we talked about. We talked about a lot of different things, but I think you're a great example of an investor that has been able to be successful doing multiple things, okay? Short-term, long-term, single family, commercial, mobile home parks, whatever. And that's impressive. And I think that's encouraging to people who maybe get bored. They're like, man, if all I did was just buy single families, or all I did was buy mobile home parks, it just doesn't seem like it covers it. So very cool. Thank you for thank you for being on. I was on your podcast recently, so I was saying thank you for having me, but we're on mine today. But anyways, who should get a hold of you, and how can they get a hold of you?
I'd say anybody with residential real estate interests in Austin should get a hold of me. And I think the easiest way to find me, obviously, you just Google Jordan Moorhead, but if you go to @Jordan_Moorhead on Instagram, it's probably the easiest way to reach me. And my phone number's all over the internet, so it's not hard to find me. But
if you need to stalk them, it's not too hard.
Go ahead. Yeah, absolutely.
Yeah. And that is, so we'll make sure that we have your contact information in the show notes as well. Appreciate you being on the show. Guys, we'll see you on the next one. Thanks. Thanks for listening. I hope you got out of this as much as I did. I'd really appreciate it if you could leave a 5-star review so we can reach more people. Jump over to mariodattilo.net and find out what else I got going on. Be sure to connect with me on all the socials, and I'll see you on next week's show.